So good morning again, and welcome back to Financial Fitness Friday. This is session number 8. My name is Matthew Mitten. I am partner at Second Sight, and I'm standing in for Darren Laverty today. As you can see, he's not here. Lucky man is on holiday. Pleased to say he's not in France, so he won't have to quarantine when he gets back. So that's good news. For those of you who've not been on this before, Second Sight is part of the Foster Novo Group, a national financial advisory firm. We're not here to sell you anything today. I'm not here to sell you anything. This is really about providing you with some information, and it's really all about financial well-being. And today's session, as you can see, is about protecting yourself and your family financially, which I guess is a friendlier way of just talking about insurance, which, if we're honest, is not the most exciting subject that some of us can dream up to talk about. So we've come up with a more friendly name. But one of the things hopefully you would know about if you've been on these sessions before is, we try and do everything in easy to understand English, non-jargon, all that kind of stuff. And I'm going to try and continue that today in Darren's absence. As I said, this is series number 8. All the other sessions are on YouTube. So if you've not seen any, you want to go back and have a look, they're on YouTube. Just search for Foster Novo or Financial Fitness Friday on YouTube, and you can catch up with them there. The whole reason we brought these things out, yes, it's a bit of PR for us, but it's a lot of uncertainty been going around for a number of months now, particularly people worried about their finances. So we thought, well, can we do something just to help people out, to try and give some people some useful information, and try and get people to feel a bit better about their finances. And as I said, this is going to be the last one in this particular series. We need to go away and come back stronger, some might say, but we need to regroup and have a think about what the next sessions are going to be like. So I'm hoping that's where you guys can come in. Actually, we've had so much great feedback. I checked up today, we've had over 1,000 views on YouTube, on collectively on all the videos, plus the people who have logged in. So it's gone down really, really well. And what's been really helpful is the feedback we've got at the end of these sessions. So I'm going to talk for about 30 minutes with my guest speaker today, who's David Davis, and we're going to talk to you about this financial protection. But after 30 minutes, some Q&A, and then once you leave the session, there'll be a pop-up about some feedback. And if you wouldn't mind, it's really helpful for us. Tell us what you like, tell us what you don't like, what you want to know more of, what you want to know less of, and that will then start to help us shape the sessions. I've got to put up a little bit of a caveat, a bit of a warning today. I did a session yesterday, and for the first time in lockdown, my Wi-Fi was very intermittent, cut me out. And I'm pleased to say I was able to get back on again in 30 seconds. If that happens today, please don't log off. Stay on. I'll come back on. David is also a co-host, so he might be talking at the time. So if I do lose you, please don't lose faith. I'll be back on as soon as I possibly can. But touch wood, hopefully that won't happen. So yes, so for those of you watched this before, the format you're probably familiar with as kind of a little bit of an intro from me. Then we'll have a guest to co-host and answer some questions. And again, if you're newbie, then obviously that's kind of the format. We'll be talking about how to protect our family and our loved ones today. A really, really important subject. And as I said, David, who is a financial advisor at Foster Novo, will be available during this session. But also, if you've got questions and answers during the session, questions, should I say, please use the Q&A function in the chat up there, and then we can hopefully answer those questions at the end. Any that we can't answer, we promise to come back to you separately, basically to answer any questions that might be specific to you. So whilst I'm interviewing David or chatting with David, please do send in your questions. So just to recap, in the past, Darren has talked a lot about financial well-being and the definition of financial well-being, about living within your means, having low levels of financial stress. And one of the key aspects, the key pillars of financial well-being is having firm economic foundations. And that's what this one is about. It's about an extension of that. So having firm economic foundations. There was a previous one about estate planning. There's been other ones as well. And the idea of firm economic foundations is knowing where your money goes if something happens to you, and making sure that your family, your loved ones, are well looked after. Because Darren's also talked a lot about the psychology behind financial well-being. 80% of financial well-being is a psychology, about how we feel about things. We can't always determine or have any influence over what happens to us, but we can influence how we might react to that, how we feel about those things. The 20% is mechanics, and we'll be talking a little bit about the mechanics, but and that'll be Daffod's role, but also a lot about the psychology, about the why we need to do these things. And I come back to this thing, insurance, I get it, it's not the most exciting thing in the world. People don't wake up and go, yay, I've got to sort my insurance out today. But it's a really, really important part of our financial well-being. And it's so important. It's a real question, it's really personal. So, you know, some of the reasons why we do these things, why we actually get motivated, the psychology that gets us to do something is because we're motivated to do it. And often it could be fear actually that gets us to do it, because fear for our families may suffer, or ourselves, we may suffer. But that's quite a powerful motivator. And when it comes to insurance, it tends to be about protecting us, our families, our loved ones. So it might be, you know, we just need to reconnect with that to understand whether it's something we need to do. Again, other reasons we may not be looking at this is because our industry is full of jargon, and that puts people off. It can be regarded as complicated, and I get all of that. So we're going to try and debunk some of those myths today. We're going to try and talk through some of the terminology, just so you understand the different basics behind the different products that are out there. Also, insurance can be a bit uncomfortable to talk about, okay? The idea of talking about losing a loved one, about going off long-term sick, having serious illnesses, these are not particularly comfortable conversations. So for some people, that might put them off having to want to have that conversation either internally with themselves or potentially with their family, their spouse, their partner, their children. You know, those conversations can be difficult to broach. So again, hopefully today we can help you with some of that kind of thinking about how you might want to have those conversations. I guess the other reason why we might not like to look at insurance is it's going to cost us some money. And so the idea of us spending money on something that we may never claim on, may never need, okay, that's often something that sits in the back of our minds as well. But the reality is we insure pretty much everything in our lives, from mobile phones to home and contents to buildings and home insurance. But actually, we often don't insure ourselves or under-insure ourselves. And yet it's so, all of our lifestyle, everything is reliant on us to be able to produce an income, to produce capital, to fund all those things. So it's bizarre that we insure pretty much everything that's inanimate, but we don't insure the main engine of that income producing asset, i.e. ourselves. So, cost is a factor, and we'll probably talk a bit about that as well. Anyway, whatever the reasons are, whether you've looked at this before, whether you haven't, I'm hoping today we can give you some ideas about why it's important, what you should look at, some debunking some of the technology and the jargon. And as I said, we're not trying to sell you anything today. It's really just about trying to give you some pointers, some tips. It's not really about products, so it's really about just the content. So I'd like to introduce Daffod in just a minute. As I mentioned before, he's a financial advisor at Foster. He's here today to talk to us about some of the aspects to do with financial protection. Daffod, are you there? Can you hear me?
I can hear you, but I don't seem to be able to start my video.
You can't start your video?
No, it's saying you cannot start your video because the host has stopped it.
Let me try. Sorry, this is me, obviously, in my inexperience. Try that now.
Fantastic. There we go.
There you are. Hello, thanks for joining us.
You're welcome. Good morning. Oh dear, I'm not too sure if everybody else is experiencing it, but it does seem to be that Matt's internet connectivity may be playing up a tab.
That we see. Can you talk through this? Did you hear that or not?
No, terribly sorry. It was very intermittent. So could you just start again on that question, please?
Okay. So, sorry,
this is obviously loud and clear now. That's great. Good.
My internet's playing up. Sorry. So the question I wanted to start with you, Daffod, is if you could help just by debunking some of the jargon that's associated with our industry, particularly with insurance. Lots of different products out there. can you try and explain in plain English what all these different things do and why people might have them?
Yeah, most certainly, Matt. Thank you. So on the list here, we've got 5 main insurances. So life assurance is the really generous one. So if you die during the policy term, it pays out a lump sum to people you care about so that they can continue as best they can without your presence being here. So life assurance tends to be taken out for key things, maybe mortgages, and also the financial provisions that we want to make sure we leave our family with in the event of us no longer being here. So that's the generous one, and it just pays out on death. Really nice and simple. Then we've got critical illness cover, which that pays out on diagnosis of a whole range of serious illnesses. And there's a lot of scope of the cover that varies from company to company and provider to provider. So there are some really quite limited plans that only cover a handful of conditions. And there's some much broader policies out there which cover well into 3 figures of different key illnesses. We've then got income protection, which that's kind of long-term sick pay. Okay, so the previous 2 pay out a lump sum either on death or on serious illness. With income protection, think of that as your independent long-term sick pay, and you can have it so it pays for a limited period of time, a couple of years, up to 5 years maybe, or you can actually have policies that pay right through to, say, state pension age, which by far, if it fits within the budget, is definitely preferable. Those are the 3 that we'll be talking about in a bit more detail, I think, in today's session. Then we've got the private medical, which that means, in effect, you're able to get quicker treatment. You're looking at shorter waiting times, maybe have a private room rather than being on a ward. So we're able to give you that little bit better service in the event of something happens, to help you be able to bounce back that bit quicker, get treatment that bit quicker, and hopefully be able to move forward with life nicely afterwards. And then the bottom one that we've got on here, accident, sickness and unemployment, tends to be quite a restrictive policy, generally quite limited on the payout, maybe 12-month period. Tends to be quite expensive and quite restrictive on the cover that it provides, but it is something that's out there. And if you've got one of those policies in place, probably worthwhile having a look at the particulars of it, and definitely reviewing that in the near term, no doubt.
Thanks, Stafford. And so yeah, as you said, we're probably going to focus just on the top 3 today. Life assurance, critical illness cover, they pay out a lump sum. Income protection, as it sounds, pays out an income in the event of ill health. So my next question is, why is all this stuff important to us? Don't we get all this from our employer, or doesn't the state cover us? There's something.
Indeed, you'll have some cover from your employer. And I see Matt seems to be freezing up a little bit there, but I'll crack on. So yes, you'll have probably some cover from your employer, some death in service, maybe. You'll get some sick pay, but that may well stop after a period of time. And the cover or the benefits that are provided by the state are really quite low. When you have a look at things like earnings support allowance, ESA as it's referred to, or PIP, those are numbers generally around sort of £100 a week, which when one thinks about a family's financial needs, to go from being fit, healthy, being able to go out there, work, earn a living, get a nice paycheck at the end of the month, to going down to maybe just into 3 figures a week of income, £100 a week, that's really going to be a big shock to the system. And quite a lot of them as well are means tested, meaning that if you've got a bit of savings, you may actually not end up with very much at all in the way of benefits from the state. So it really is important that we take responsibility, take the onus ourselves to ensure we've got the right cover in place, so that should something happen, we know that the financial impacts of it are somewhat more manageable.
Brilliant, thank you again. So I think what I heard there is that we do get some stuff through work, but I think it's worth checking things like how long is your sick pay for. Some companies pay full pay, some pay full pay then half pay. It depends really on the circumstances. So do check that if that's in your handbook, or speak to HR about that. I think it's fairly safe to say that the most common benefit offered through an employer is life assurance, death in service as a multiple of salary, and then probably income protection. And lastly, some employers are starting to offer critical illness cover, but not all of them. So I know that's still quite low down in terms of sort of popularity. But obviously, it's important to have enough cover in place. are there any kind of basic rules or guidelines that we should follow when it comes to looking at these things or to reviewing things that we have in place?
Very much. It's something that what you want to do is, there's no sort of set formula for it per se, but what you want to have a look at is what are the family's needs. So sit down, if there's two of you involved in the household, there's two owners or two adults that are there indeed, look at it and go, right, well, in the event of one of us not being here, how does the future look? And work out what cover that's provided by the work, so death in service, and then look at what you'd actually like to be provided. And if there's a shortfall there, if there's a difference, then indeed one needs to be starting to look at getting some independent cover in place. But it is something that really varies from person to person and family to family of what is needed for that household. So it's something that you really need to sit down, get the pen and paper out and work out, right, in the event of one of us dying, what do we need to have? In the event of one of us being unable to work for a period of time, what happens? How long do our savings last us? And after that, well, you need to have something in place for it.
Thanks again, David. So I mentioned earlier on about some of the stuff can be a little bit uncomfortable to talk about. And have you got any particular kind of sort of tips or ways that people might kind of start to talk about this? We've got an example in a minute, which I'm keen that we get to. We talk about a case study, but obviously you operate in this space regularly. How do you kind of get people to want to talk about this stuff?
It's just being very frank and matter of fact about it. I mean, it's not a nice subject to talk about. One way that I think does help is thinking of it as disaster recovery insurance. Okay, it really is about this thing that you're paying for that you really hope you never need to claim on. But if indeed you do claim on it, then it is going to prove invaluable at that time. So it's looking at working out, right, that disaster recovery insurance phrase is something that I tend to find fits quite well with people when you're looking at it and taking a logical view at the finances and saying, right, what do we have in place? What's the company benefits? What's the family obligations? What debts do we have? What financial needs do we have for our future? And indeed, when we look at those needs and what's in place currently, then that shortfall of what actually needs to be provided is where we start looking at going, right, let's get the independent insurance in place and look to get that priced up for people.
Excellent, thanks. So I think it's fair to say a lot of us have probably bought insurance in the past at some point, and we could have bought that from a variety of different sources. That could have been from a broker, could have been directly from the insurer, could have been from different places. Why is it important that we kind of review these things on an ongoing basis?
Well, to be quite frank with it, the definitions on insurance policies, particularly things like critical illness and income protection, they do change over time. So it's something, the policy that was set up many years ago may have a more restrictive scope of cover than what's actually available in the marketplace. People are living longer. We are generally living healthier lives, which is great. And of course, that can have quite an impact on insurance premiums. So I wouldn't suggest that your family suite of protection is something you review every year. It's really at kind of the key events when you're taking on board new financial obligations, whether that be moving house, expanding the family. There's a big cost involved with bringing kids up, or whether it's more a case of every sort of 3 to 5 years, it's probably worthwhile having a look at the plans and just checking that they're still relevant and set up in the right way, because we don't want to just sort of set this stuff up and forget about it. We want to make sure that in line with how our spending changes, in line with how our future financial trajectory is changing, hopefully improving as our career progresses, that we're also updating those financial protection policies. So we haven't got stuff that's insuring us for the lifestyle we had 10 years ago. Instead, it's protecting the lifestyle we've got today.
Excellent. Okay. I'm just also thinking about the different types of insurances. Again, going back one step, just as we talked about the fact that life insurance pays a lump sum, critical illness. There's lots of different types of life insurance out there, though, isn't there? And sometimes, it can be quite confusing knowing which one's the right one to take. Can you just explain kind of very quickly the different types of life?
Yep, so we've got the two main types of life insurance that exist. We have okay, so you get some intermittent parts of Matt's question popping through, but I'll just roll on. So you've really got two main types of life assurance. We've got level term assurance, which pays out a flat sum throughout the term of the policy. And then we've got decreasing term assurance, which as the policy years go by, the level of cover goes down. So level term assurance, it's going to pay out the same amount on day one as it would in 20 years' time. Decreasing term assurance, it tends to decrease over that policy term. Decreasing terms generally used for things like mortgages. So as you're paying off the capital each month, the mortgage is going down in balance each year. You can have a plan that goes down in line with it. So that specific debt in the event of something happening is paid off, and that could be life. You could also have critical illness on that so that it pays off in that instance. Or indeed, there is the level term assurance. Now, both of these phrases have the word term in them, and they cover for a finite amount of period or finite amount of time. You can also get something called whole of life insurance, which covers you for all of your life, which pays a lump sum as well. So you've got level term pays a flat sum throughout the period, decreasing term goes down over the period, and there's also whole of life, which, as the name indicates, covers you for all of your life effectively.
Okay. Thanks again. Apologies if there's some intermittency on my connection. I blame my kids, and they're probably about getting up by now, starting to use the internet. So it'd be great. I've got an example here that you and I sort of talked about beforehand. Perhaps we just sort of kind of talk through that for a moment, and I'll get this back up on screen, and you can talk us through the benefits of looking at a review and why that works. Bear with me 1 second. Is that on view? Can you see that?
Yep, I can see that. That's popped up nicely. Thank you. So what we're looking at here is a chap who's a non-smoker, 35 years old on the next birthday. That's kind of way insurance tends to work. And we're looking at them earning 50 grand as a project manager. So this individual's got about 3 grand a month net probably hitting their bank accounts. They've got no children, but no doubt they've got bills to pay and financial obligations. They need to make sure that if something were to happen to them where they're unable to work for a prolonged period, they can continue to survive, hopefully recover from whatever it is, the illness or sickness that they've got, and then bounce back and continue living a nice life in the future. So like we spoke about, this is all about having that financial resilience, about having that disaster recovery insurance in place. So this person, they've got no children, so it's really just themselves. So we can have a look at what might be appropriate for them to have. Well, having a bit of critical illness cover in place. So this example, we're looking at level term assurance. That's going to pay the same amount throughout the term policy of a couple of £100,000. So on diagnosis of a critical illness, a lump sum would be paid. Looking at this running through to state pension age. And then we've got the income protection, which is going to be providing £2,500 a month. There's no income tax paid on that. That is the net amount that the individual would receive. And that's increasing with inflation. So to keep that relevant, to make sure that in 10 years, 20 years time, the buying power of the money is protected, it increases with inflation each year. We've got the 6-month deferred period there. That's how long it is before the policy starts paying out. And you can tailor that to in line with your company sick pay. And so if you've got 6 months company sick pay, you might look at that kind of a period. If it's maybe got a bit less company sick pay, but you've got some good savings in place and you could tie yourself over for a few months, then great. Really, the further out you can push that deferred period, the cheaper the premiums become quite nicely. And then yet again, running through to state pension age. So this is all looking about trying to ensure that in the event of significant ill health, so they can't work for a long period of time, or diagnosis of something nasty, financial provisions are in place so the individual can focus on getting better rather than worrying about trying to pay the mortgage or trying to pay the bills and get to hospital, so forth. So in this example here, we've put up the costs, and the range of pricing on these really is quite significant. You can see here you've got from £110 up to £175. And that's all due to the particulars of the different policies. And that's looking there without any life insurance on the plan. if we just press the button again there, Matt, I think it's going to bring up the cost with life assurance for this chap.
Yeah.
Sorry there, Matt, if you could, there we go, fantastic. So you can see here that whilst this individual with no children haven't really got any need for a death benefit to be paid, there's no one really they want to be leaving a legacy for, they need to try and ensure financial provisions are assigned for. But when you actually look at adding in a couple of £100,000 worth of life cover, it's only just over £1 a month in this example. So it's something where if somebody was maybe just looking online and going, right, I just want a bit of critical illness, or they was going to a non-advised provider and just said that's what they wanted, then okay, they'd get quoted on that and no doubt get that in place. But when you have a look at it, for the extra £200,000 of life cover, just for an extra £1 or £2 a month, it's something that offers very good value to get that scope of cover when you're young, fit, healthy, no health complications, so you get it on the good low premiums really. This is just an example of the kind of protection that one can have. And if we have a look here, £3,000 a month net coming in, to be spending £100, £150 on some insurance, it's not really a huge outlay there, but it is something that provides that longer term security of knowing that there's going to be income coming in if you can't work for a long period. And indeed, on diagnosis of something nasty, you're going to get a lump sum to be able to allow you to focus on getting better rather than having all the usual money worries, as it were.
So really helpful, Daphne. I think £100 a month, that's the peace of mind that you're spending to get that. So that's what it's going to cost you for peace of mind. And when you come to financial well-being, we come back to this whole point about, what is it that helps us to feel better about our finance. Hello.
Hi there. It seems to be quite patchy.
Did I cut out again then? Sorry, I was just asking why there was a limit to how much he could insure himself for 2,500. Why was he not insuring for 3,000?
Indeed. So when it comes to income protection, there's certain set limits that the insurers go up to. In effect, they don't want you to be in a position where you're going to be better off through being ill. You can't go over it. You can't insure more than what your income is. And with insurance, there's those set levels. So you're typically looking at it being sort of the 60-75% level is where indeed that is capped at. So it's something that if it fits the budget, going for as high a level as possible is great. One of the things with insurance is you can really tailor plans to the specific needs and the budget. So one could actually say, well, if there's a slightly lower level of essential outgoings, one could look at just covering for that. So it all depends on how it fits in with the budget and the general family, general individual's finances at the time.
Great. I'm conscious of time, so I'm going to crack on with the next couple of slides just very quickly. So there's a cost of delay here. We're talking about people maybe putting this off a bit. Just talk us through what the impact is.
Yeah, great. So what we've got here is the same individual looking at the amount of cover that we were just looking at. So we're looking at 35-year-old, and they delayed it 10 years and took it out when they were 45. The premiums, you can see, they go up on the lowest cost provider there from 112 a month to just over £200. And that really is quite a big increase. It's sort of another 80% a month or something like that. Also, there's been another double. Yeah, really very nice. And also, it's something where that's another 10 years of life a person has had. With insurance, we really want to be taking it out when we're fit, young, and healthy, and we've had no health complications. In which case, we get the broadest scope of cover, the really nice low-cost premiums that we can lock in for the life of the plan. As life goes by, things can happen, which means the insurers may say, right, well, you've had that health complication or that health scare. We're now actually going to charge you more than we would somebody who hadn't had that. So locking in a good broad level of coverage when you're that bit younger not only gets you cheaper premiums, but also it ensures that you've got that full breadth of cover from the provider.
Right. Okay. And last example. So this is true.
Okay, we've got
I don't
these
know if you
slides
heard me
coming
again.
up
I
now.
just asked you to talk through this one. Sorry, I obviously got connection again. So can you just talk us through this example very, very quickly as well, please?
Okay, we'll do. Yeah. So what we're looking at here, a couple of just knocking on 40. They've got 50 grand a year each coming in as project managers. So they've got about 6 grand a month coming into the household. And this is just looking at the difference between joint mortgage protection or having separate policies. So these guys, they've got a mortgage for £250,000. It's a life or earlier critical illness plan that we're looking at here for this couple. And the mortgage is on a repayment basis. So the insurance goes down over the term as well. So that decreasing term insurance, like we spoke about earlier, is what these guys have got. Now, they could choose to get a joint policy, which means if either of them were to claim, so if either of them were to get a serious illness, the plan would pay out and then it would stop. If either of them were to die, the plan would pay out and then it would stop. That would cost £117 a month for this couple. So if they were to go for separate policies and in effect have double the cover, then you're looking at the premiums not increasing massively there. For the life cover, it's only an extra £1.80 a month. For the serious illness element, it's another £12.70 odd. So it's something that when you're looking at mortgage protection policy, so if you've got a debt in place and you want to get the life insurance, critical illness cover to make sure that's paid off in the event of something happening, if it's within budget to go for separate policies, then why wouldn't you want to have double the cover for only, as you saw there, it's only about 12% extra cost.
Brilliant. Thanks for running through that. That's very helpful. So we've kind of got to the end of that 30 minutes. It's gone really quickly. I'm opening up now for questions and answers. If anybody has any specific questions, please either put them in the chat or preferably in the Q&A, actually, if you could do that, because then we can record them and come back to you. I've got a couple of questions in here actually come through whilst you've been chatting. The first one, you mentioned whole of life earlier. Why would someone take out a whole of life policy as opposed to a term policy?
Indeed. So whole of life tends to be something people might look at when they're planning for inheritance tax. So we have inheritance tax thresholds. We can pass on a certain amount tax-free to our loved ones in the event of death. But over that level, then there is a quite aggressive tax that's applied, which is at the rate of 40%. And so what whole of life allows to happen is you might take out a joint life second death policy. So when the second person dies, a lump sum is paid out to ensure the tax bill can be paid efficiently and quickly, and then it can ease probate at what's a really stressful time. So for instance, if there's a large family house, then it can be particularly complex with regards to having to pay the tax before you can get the ownership of it to be able to sell it. And so having a whole of life plan in place, it's a very cost efficient way of looking to plan for that future tax liability that provides some quick money to be able to pay that tax bill, to be able to then distribute the estate efficiently at what's really quite a stressful time for everybody. So whole of life tends to be more for inheritance tax and estate planning aspects, that one.
Thank you. I've just been reminded I need to flash up this screen here so people know we're not giving advice, this information only, just a compliance slide. So I've just flashed that up there very briefly to make sure everyone can see that whilst we continue our conversations. I've had another question come in here as well. You mentioned earlier there's a lot of critical illness policies out there with different levels of or numbers of illnesses that are covered. I think some are as few as like a dozen illnesses. Some are, as you said, run into the hundreds. Should I be looking at the one that's got the most? Is that kind of the best policy, or what are the pitfalls I should be looking out for if I'm looking at critical illness?
if it's within budget, then arguably, if you're going to be paying a premium every month for decades, then personally myself, I like the idea of having the broadest breadth of coverage possible. And that's something that you can see some very low cost providers out there that, as you touched on, we spoke about earlier, they only cover a handful of things. And then the chances of you just getting one of those things is really probably quite limited. So it is something that very much is beneficial to have a look at the terms of your policy that you've got. If you've got policy in place already, look at what it's covering you for. And then have a look at, if it's not into kind of the three figures, then indeed it's something you might want to be speaking to somebody sooner rather than later about getting that broader based covered, most certainly.
I think it's fair to say that all the critical illness cover the main things: heart attack, cancer, stroke. Those are the sort of three major ones. I think I was looking at some statistics recently that makes up the majority of claims in critical illness. Obviously, I take your point. You want broader if you can get it. Obviously, affordability is a factor. One of the other things that was kind of, I guess, a general point that was raised probably at the very beginning around, is there nervousness that insurance companies wouldn't pay out? I mean, I don't know if you've got any kind of experience of that, but I think sometimes there's a perception that insurance companies, they'll take your money, and then when you get an illness, they'll say, sorry, you didn't meet the criteria. There's been a lot of that in the press with regards to the COVID-19 crisis. What's been your experience of dealing with insurers in this particular market with regards to life income protection and critical illness, I guess, in particular?
Indeed. Well, they price the risk accordingly, and they're all very keen to have very high payout statistics, because that's something that gives the consumer peace of mind. So what they don't want to be having is a whole load of people paying money for insurance and then getting a low payout statistic, because that's something that means nobody's going to be buying that product from them in the future. And indeed, when you look at the payout ratios for these insurers, they're well into the high 90% of claims that are put in. When you're talking about the critical illness side of things, there are quite a few out there that are getting just over 99%. So we're getting right up to these numbers where you're paying that monthly premium. You've almost got that absolute certainty, that if in the event of you getting something bad, that policy will indeed look to pay out. With life assurance, quite a few, those statistics, because you only die once, and when you're dead, you're dead. They very much are. There are quite a few that are up at 100% for those. And it is something that I'd say as well. There's been quite a change in the insurance industry with, several decades ago, maybe it was a little bit more about them looking at it and trying to work out, is there a way for them to not have to pay it? Whereas now very much the communications that we're seeing and the way that we're seeing them handle that claims process, it's far more considerate, far more caring, and far more with a want and a will to be able to pay out if they can, because they want to try and get those really high payout statistics to be able to attract more customers and do good business that's priced at the right risk for them.
I think you're right. I mean, that's a good point. Insurers want to have good reputations, don't they? So a very good point. I've got another unstable warning on my internet coming up. So I've got one final question for you, and then if there's no others, then we can talk about it. What about exclusions? And we talked about the cost of delay earlier. If someone got an illness, there's a couple of things could happen, couldn't they? They could potentially get rated. So if you've had a previous condition, your insurance policy might be more expensive. Could it also have exclusions on things as well? Is that another reason potentially to get it early?
Yeah, very much so. And it's sometimes it's the health scare that prompts people to actually look at this, and it's really it puts myself as an advisor in quite a difficult position, because the one thing that they're really wanting cover for, it may well be that the insurers are saying we'll cover you for everything else except for that one thing that's really motivated you to come along and talk to us today. So yet again, it's about trying to get that cover in place when you are fit, young, healthy, haven't had those health scares. Get that broadest range of cover for a good price, and then you're not going to have any of those exclusions applied. With regards to rating the premiums, what that means is they might say, well, because of X, Y, Z, we see you as a higher insurance risk, so we're not going to give you the standard premium. It may be 25%, 50%, or even double the price of a normal applicant for that type of cover. With exclusions as well, one thing I will mention about those is it's something that, whilst you may have had some kind of health scare that's prompted you, or something's happened to a friend or family member that you've gone, right, this is the time to look at it. If there are any exclusions or weightings applied, then typically they may have a time scale where if you're fit for a certain period of time, maybe 5 years, then they may actually be able to remove that exclusion, or you may be able to reapply with a different insurer and not have that applied. So it is something, if you've got rated premiums or exclusions on existing policies, and they were set up a little while ago and you've been nice and healthy since, then indeed very worthwhile having a chat with an advisor to see if you can now get that added back into your cover in light of being healthy for a period of time.
Fantastic. So I'm conscious of getting towards the end of our session. I've had another question come in whilst you were talking. A good question coming here. Is critical illness cover limited to a number of years, i.e. is it a term policy only, or can it also be for whole of life?
That is a very good question. In the years that I've been doing this, I've never seen a whole of life critical illness policy. So I would be very confident in saying that it's only for a term is how the critical illness element works. If you start looking at getting critical illness cover into the late 60s, into 70s, then the premiums really do start getting very expensive. You know, it's because of course the likelihood of things going wrong around that time, that's the age where the risks increase significantly and the insurers need to price for that. So no, critical illness indeed tends to be just a term policy.
So in theory, you could get a term policy into your, the chances are it'd be unaffordable because it's almost guaranteed to claim on it. So I think I'm just going to kind of wrap up now. I really appreciate your time, David. I know you're busy, so that's been great. Thank you.
Thank you.
I think there's some sort of key things or takeaways I would suggest that if people are interested in progressing to next steps on this, clearly check what you get from your employer is a very good place to start. What sick pay you get, what life assurance you get, do they offer critical illness? Sometimes it's on a voluntary basis, you have to sign up for it. Then potentially look at your policies. If you bought some already, how long ago did you buy them? Is it worth potentially reviewing those policies? You can find financial advisors either on unbiased.co.uk or through Vouch4 is another website to get access to financial planning. So check your policies, check what you get at work, I think would be the key things. It is well worth reviewing. I think the other reason we review these things is because obviously the policies improve, but sometimes you can get better premiums. Your premiums can come down if you've reviewed it because certain players in the marketplace are looking to attract business. So another good reason to review your policies. I'm going to finish up now just by asking once more, just to kind of, once you sign out of this session, please do complete the feedback form. It's not about the quality of the Zoom call. We know that wasn't brilliant on my end, so I apologize about that. But it's more to do with what you thought was useful in terms of the content, what more we could do next time, and then we'll feed that back in, and hopefully we can come back with another load of sessions around Financial Fitness Fridays. So that was a bit of a mouthful, but that's going to leave me by saying thanks very much for joining us. Thank you to our guest, David, and I hope you all enjoy the weekend, and we'll see you next time. Thank you.